Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader, and I'm here with your Cabot Weekly Review, the first one of the new year. I am recording this late Friday morning, January 6th, okay? So the evidence hasn't really changed with the market at this point. The intermediate term trend is sort of flat to down. Now for the NASDAQ, it's not good, but for the other stuff, it's not good, but it's not, a disaster. The longer term trend is down, and we're just still seeing a lot of selling on strength out there. And when it does come to growth stocks, which is my bailiwick, but also kind of a sign of the times, kind of a sign of the health of the market, risk on, risk off sort of thing, they continue to bring up the rear while defensive stocks and stuff like that are doing well. So overall, I still think less is more, small positions, buying on dips, sort of hit and run, stick and move sort of thing is sort of the if you want to be playing in the market. Now, I will say that we have seen some positive divergences from the number of new lows, which I'll show you here, some improvement in the broad market. I'm seeing some stocks sort of on longer term basis begin to tighten up, sort of, keep forming kind of consolidations that are tighter and tighter, which is kind of typical for, longer bear markets. You just kind of see more and more stocks sort of look ahead. And there, there's just definitely more not really growth areas, but there's definitely a few areas that are hanging in there and doing okay, stuff like that. So I do think that if the market, I know I've said this in the last couple of videos, if the market has a good week or two, which it hasn't, but if it does, I think there could be some stuff to work with. I don't view this as like June or October when everything was kind of on its back. I view this as like not a good environment, but if the market turned and if we saw a few stocks pop higher, and if the indexes had a few good days, you could have some that are above all their moving averages, longer term, short term, the whole thing. So it's definitely worth paying attention to, having your watch list in place, being on it, because the market's looking 6 months ahead. And if it likes what it sees, it can get going. But again, as we keep saying, we want to see it first to really put any meaningful money to work, really get heavily invested in the market. In Cabot Growth Investors Model Portfolio, which of course is tilted toward growth stocks, we're about 80% in cash because that area of the market's pretty much the weakest there is out there, generally speaking. But that said, the level of cash less important than just being defensive, but just keeping an open mind, seeing how things go. It's a new year, and if the market likes what it sees 6 months ahead, it can kick into gear no matter what the experts might say. Okay, let's hop into the charts. I'm starting with stockcharts.com just to show you the new low thing I was talking about here in a second. So this is the number of stocks hitting new lows on the NASDAQ. I know you can't see my cursor, but this is day by day for the last 7.5 months, I guess. And the line at the bottom there is just the line chart of the NASDAQ. The bottom line here is, to the left of the chart, you can see when the market was bottoming in June, you had 1,100 stocks. You know what? Let me take off this log scale. You had 11, that makes it easier. You had like 1,100 stocks, hitting new lows in the NASDAQ. September, October, you had between 1,000 and 1,200 were the peak readings. And then we kind of retested the low here in late December, even really this morning, actually, if you look at it. And you're getting, 500 stocks hitting new lows, about half as many. Is that the be-all, end-all? No. Could there be some sort of end of year, beginning of the year stuff going on? Yes. You often see some cross currents early in January as people sell prior, winners because the tax, the calendar is flipped for taxes. Maybe buy up some beaten down stuff, that sort of thing. So there can be some games being played here, but I like to just go with what I see. And the positive divergence is definitely a small positive. And then if you shift to the New York Stock Exchange, we call this our 2-second indicator, which we've been following for 50 years or something. It's just the number of stocks hitting new lows on the New York. People like to look at new highs and new lows. We like to look at new lows. It's a sign of the selling pressure, especially in a bad market. What you want is the selling pressure to ease. You don't necessarily need the 100 stocks hitting, 500 stocks hitting new highs right away. I think in 2009 you didn't have many 52-week highs for months and months and months, but you had new lows really dry up. The blue line there is the 40 level. 40 is kind of our demarcation line. There's nothing magic about it. Usually when the market gets going in a big way, especially after a bear market, you'll see these readings not just below 40, but below 20, below 10, just a real sign that the broad market is off its knees and going in the other direction. And the reason I'm mentioning this chart right here is just the first 3 days of the new year, we've seen under 40 new lows for the first time in a while. Again, it could be the early January effect, but let's see how it goes. Let's see how today goes, early next week. If I'm coming in next week and, it's all changed, I'll just, I'll say forget about it. But who knows? Maybe I come in next week, do the video and hey, now we have 6, 7, 8 days in a row. Something might be happening here underneath the surface. So just something to keep in mind that in the broad market, maybe not the exciting stocks, but in the broad market, you are seeing more and more stocks, at least to this point, resist the market's downward pull, especially like the NASDAQ's downward pull. Okay, so now let's hop into, if I can do this correctly, let's hop back into MarketSmith. There you go, which is a product of Investors Business Daily. You can learn more at marketsmith.com. Get my pen out. As usual, start with the NASDAQ. And the NASDAQ's the weakest thing. It's still like living below even that June low back here. Weighed down by Apple, Microsoft, yada, yada, Amazon, Tesla, whatever. No excuses, but it's definitely the weakest thing out here. We'll see if this was kind of the retest here. You know, you could see late last week, I guess, or middle of last week. We'll see how it goes, okay? I mean, it's definitely the weaker thing. The point I want to make, though, is if you do look at some of the other stuff, this is the S&P 500. Does it look good? No, it's below its 50-day. It's below all its moving averages. And in fact, it just fell, say, 300 points, call it, since the Fed, you know, was hawkish again in December. And it really hasn't bounced much, right? So, like, we'll see how this goes. But so far, what I would say is, you know, you're not far from like getting this going here, getting above a couple moving averages, and all of a sudden, hey, you're above the 200-day line, never mind the 50-day line. So it's a little bit of this sort of, which I'm going to talk about in a second. You kind of have this big initial decline. Here's your second decline, pretty big. And maybe this is kind of the third, more tame decline. Could we come in next week and implode? Of course. You know, I'm just trying to lay out scenarios so that if they happen, you know, I'm prepared for them. And it's the same sort of thing here when you look at another. And this is the IWM Russell 2000. You know, is it free and clear? Does it look amazing? No, but it's also not down here like the NASDAQ is. And a good couple of days or couple of weeks, all of a sudden, you know, you might be threatening multi-month highs. The mid caps, MDY, actually a little bit stronger. And even the New York Composite, which I think has been the strongest. Yeah, you can see it, the New York Composite, which is interesting because financials did get hit and energy stocks have kind of gotten hit. But you can see New York Composite has just kind of hung to its 50-day line, even during this post-Fed decline. You know, we'll see what that means. But my point here is that intermediate term trend not up, which means be defensive. Longer term trend still down, be defensive. But keep your eyes open because, again, it's not like down here where, hey, you know, if you're a trader, maybe you can play this and it rallies. But overall, you need to go up for a couple of weeks just to see where you're at. Right here, you go up for a couple of weeks pretty strongly. You might have something to work with there when it comes to the major indexes, okay? Now back to the growth arena, just to kind of hammer this home. Not that you need me to, but this is like just going through. This is the IGV. This is the software fund. Again, it's just kind of on its knees, can't get going. ARK, you know, obviously ARK's kind of its own beast, and I don't want to get too close to it, but you know, pretty much still sitting at new lows. IPO fund, almost tagging new lows here. You can see on the weekly chart. And then something I like to look at, obviously you have to get this through the some sort of Investors Business Daily product, but this is the IBD Mutual Fund Index, which is just a measure. It's basically an index of mutual funds, growth mutual funds. And yes, I'm sure they own Apple and Google and stuff, but this, you know, the chart here doesn't look like Apple, Google. It looks like a lot of the stocks that, you know, we've owned. You know, obviously a sharp decline. It has been trying to bottom out again for the last 6, 7, 8 months, like a lot of these indexes. And I think that's, you know, quote unquote good. But, you know, you can just still see, even with this, and these are real money managers that I assume, get paid a lot of money to do this. You know, it's still sitting near its lows. You know, no upside, no downside, but no upside here for 8 or 9 months. And, you know, it seems closer to kind of keeling over than getting going. You know, that said, let's see. You know, again, a couple of good weeks. Maybe you're above the 200-day line. You have something to work with. But the point here is growth stocks continue to look pretty bad while you still have, you know, here's XLP, not setting the world on fire, consumer staples, defensive stocks, not setting the world on fire, but clearly better than basically all the indexes. You know, XLU, interest rate sensitive, but utilities holding the 50-day line and bouncing. So, you know, it doesn't mean the market can't get going or the rally's toast. But, you know, again, if we do rally, it would be nice to see, you know, if not the NASDAQ or whatever, but, you know, growth stocks in general start to lead as opposed to, you know, lag, and start with these things to kind of chill out. You know, if we rally for 3 weeks from here and it's the Dow, it's the XLP, and growth and high beta stocks can't get going, you know, that's probably not a good sign. But we'll just see how it goes to this point, okay? One thing that I might touch on, I'm doing a webinar on the 19th of January I'm sure the marketing team will hit you up for it. And I might talk about this. I'm going to do some more research on this weekend. I'm seeing more stocks just as I was flipping through charts, really watching football this past weekend. They're kind of have these in a bear market that goes on for a while, not to go too far on a tangent. You'll have a huge, correction where the stock falls 50, 60, 70%. Some of them never heard from again, of course, right? A lot of the ones that were popular a year or two ago. Some will come back to some extent, but then there'll be another. It doesn't just like, hey, that's it, tightens up and goes. No, there's another 30, 40% correction. This is all over many months. And then it can kind of come back. And then the third time, sometimes it can be 3, 4, 5 of these things, but it just kind of keeps getting tighter and tighter, meaning, the sellers are kind of getting worn out. They're moving on. The weak hands are out, however you want to say it, whatever cliche. So, Celsius is kind of a great example where it fell, say, 60%. I don't have the numbers, but 60 or 2/3 or whatever, comes all the way back and then pulls back. This was a 35% correction. Not fun. Like you're not going to sit through that in most cases unless you bought way down here. And then it kind of ramped up again. And now here we are. Now look at this pullback. It's gone from, say, 120 to 100. And to be clear, the stock looks a little ragged here near term. Just to look at the daily chart, it's trying to hang on to the 50-day line, but it's been weakening here with growth stocks. But the point is you have this sort of decline. And now, it just keeps getting sort of a little bit more tame. And I'm seeing that in all areas. So like, this is Transdigm, TDG, aerospace. It has nothing to do with not rapid growth, but it's hard to see here, but take my word for it. This was like 700 down to 500. Again, 700 down to 500. And now you have 650 to 600. And it just kind of gets more tame. I'm not saying the stock's going to break out and run up 1,000 points from here, but I'm just saying you're seeing more of that action. United Rentals, URI, clearly not, growth, but if you look at the weekly chart, here's your multi-month decline. It rallies. You have another very tedious correction, below the 200-day line. And then here, while the market has had this sort of 4 or 5 week post-Fed, period of time, you're kind of getting some of this stuff tightening up. So I will be looking for some. Those are obviously things you want to look for stocks to potentially buy, hopefully in the growth arena going forward. But I am starting to see more and more of that. We'll see if what that means for the market. But I take it as a slightly encouraging sign. Okay, individual stocks. I got kind of organized it into some themes here. So China, yes. Never super confident in China. It's different, but it does seem like a follow-on opportunity to like November 2020, vaccine announcement, U.S. economy is going to reopen. Here we have China. There's not a vaccine announcement, but I think the government's finally like, enough of this. We're going to reopen. Could they change their mind and things go haywire? Yes. But this is PGJ, which is just sort of it's a thinly traded ETF. So not necessarily recommending it or anything, but just, pretty much tried to bottom out here, big shakeout, and now it's acting very well. This is a ETF of all the ADRs listed in America here from China. But PDD, this is Pinduoduo, nice breakout here on earnings, volume cluster on the daily chart. Moves around a bunch, but pull back basically to the 25-day line, now takes off again. Las Vegas Sands, travel stuff seems like pretty straightforward play. It's extended. I'm not saying the thing can't pull back, but interesting Las Vegas Sands LVS, kind of above some round number resistance at 50 here. Pretty good volume, not amazing, earlier this week. We'll see how that goes. Trip.com, there's a lot of names. I would try to stick with either, some of the liquid stuff, or I wouldn't be going down into the penny stocks in China or anything. But, Trip.com, TCOM, this is the old C-Trip, if you remember that one. But, rejected at 30, breaks out, accelerates higher after earnings, and obviously is acting well since. So just China in general, and not just China because it's going up, but China because there's that reopening theme. And, the travel statistics over there are crazy. It's like down 90%. And some of these companies are still almost profitable. So see what happens if things change. Biotech I still like, Sarepta Therapeutics, SRPT. Again, it kind of hits new highs and then comes back down to the quote-unquote breakout point, which is par for the course in this environment. But you can decide what to do. But if you're interested in these things, you probably want to buy them either down towards support or wait for, buy down towards support and then buy them on a bounce just to make sure the uptrend is resuming. But SRPT looks good. Halozyme, it could pull back more. I've talked about this before, but broke out of like a 21-month base or whatever it was. Nice rally. Now it's pulled back here, but pulled back to the 50-day line, starting to bounce. We'll see how it goes. Maybe maybe it implodes or whatever. But so far, certainly looks proper. Maybe you wait for a little bit more of a resumption, whatever. And then NBIX, Neurocrene. We've mentioned this a bunch. This was really the first one to break out above 100 here back in August. It hasn't set the world on fire, but no one's complaining about it in this environment. Retested the pivot, and it's really just been respecting the 50-day line for months, which is highly unusual in this environment. So NBIX is one I'm still keeping an eye on. But medical, biotech in general, DXCOM, DXCM, yes, it's a little sloppy, but you can look at the weekly chart, take my word for it, but in October, the stock went from about 80 to 120 round numbers. And since then, it's basically gone from, 110 to 120. Again, round numbers, So it doesn't guarantee anything, but it's certainly not attracting sellers. And, hopefully there's not a lot of supply there if the buyers show up. Inspire Medical, INSP, similar name. You can kind of see this level right here on the weekly chart has been resistance. So it's not a surprise after this run, especially in this environment, that, nice persistent run here, very just kind of straight up 45-degree line or more. So now it's pulling back here. Could it pull back to the 50-day? Yeah, sure, of course. Let's see what happens. But overall, I'm just saying it still acts proper. And medical biotech in general looks pretty good. And then so those are kind of the two, I don't want to say themes, but, there's home builders. There's some things that DHI, I mentioned this before. DHI still looks good. New multi, I don't even know, 8, 9, 10-month highs or something like that. So home builders look good. Then there's just kind of a smattering of stuff. I try not to take, like I said, early January, a lot of cross currents, unless it's a group move or everything like oils last year, where it's like, hey, here's 12 stocks all breaking out on huge volume, within the first 2 days of the year. That's like, okay, this group is probably moving higher. I'm not seeing that right now, but I do see a smattering of some interesting action. So like, this is Delta Airlines, not my kind of name, but DAL, it's been just sort of dripping here for forever. But you can see it did get off its knees here after this September, October low. The latest pullback, well, the Fed, the market's been, with the Fed here, it's been a much higher low, and now it's kind of ramping higher. So that's kind of interesting. Shift 4, I've mentioned this before, tried to get going late last year. First day of the year down 7% or something. Now it's bouncing back all over the place, but in general, you just step back, still above even the 25-day moving average, above all of its moving averages. How about that? That sounds pretty good. And not far, obviously, from whatever, multi-month highs here. So FOUR is definitely on my watch list. Commodities are a mixed bag, but there are a couple pockets of strength. This is Freeport Mac brand. This was in top 10. This one did go through the ringer. I mean, it fell 50% in I think this is like the summer into the fall. Double bottom. And it wasn't like it really changed character, but it was up a few weeks in a row. And then you have this tight area here kind of to close out the year. You can just see very tight at the 10-week line. And now you're seeing, again, it's not the biggest breakout of all time, but again, you're kind of at multi-month highs here. Looks like volume's going to be high today. I'm recording this. It's 11 in the morning. We'll see what happens, okay? Same thing with oil service, which oil producers are sloppy, but oil service looks interesting. This is Weatherford, WFRT. It has had a big comeback here after, it came out of bankruptcy a couple of years ago, so it's still kind of all over the place. But, so maybe it's, a little bit ripe, so to speak. But, they try to hit it one day, holds a 25-day line back up, huge numbers, seems cheap. Technip FMC, that's kind of an interesting name, but the symbol is FTI. Same sort of thing. You just kind of have this uptrend in place, and I won't say tight, it got hit here about a month ago, but it's kind of respected the 50-day line on the daily chart. You can see just kind of hugging it. And then today, anyway, it seems like it might be getting going. Again, I'm recording this in the morning, so we'll see how it closes. But we're seeing some oil service stocks, even though oil prices are down in the mid-70s or whatever, some of these things are still holding pretty firm. And then just a couple more. Again, hodgepodge. This is CROX. It got destroyed, but it's been kind of stair-stepping its way higher here the last few months, including, you can kind of see this tight action here, again, into the 10-week line, and now extending higher. So that's kind of interesting. And then MasTec, MTZ. This is more of a infrastructure play, which can come and go. Some of these things look good and then they don't. But again, you just kind of had this, endlessly kind of move into new low. Finally, after this September, October bottom, 6 or whatever weeks up in a row. And again, while the market is and the Nasdaq's near its lows, stuff like that, you can see Mastech has pulled back. It did pull back, but pretty calmly, pretty much held. It looks normal on the pullback. You can say moving averages or whatever. It looks normal, starting to try to reassert itself on the upside. Okay, so overall, I mean, I think my message here is A, growth stock still lagging. B, though, when you look at the indexes, this is the Nasdaq. When you look at like the spiders, SPY, is it good? No. Is it terrible? No. It's it's not bad. It's kind of more sideways than down, near term. And if capital I, capital F, we have a good couple of weeks, which we haven't, but if we do, you could have a situation where it's like, wow, we're sitting here at multi-month highs above all moving averages. Maybe some stocks kick into gear. Maybe we get some earnings gaps. So the point here is not saying, hey, I'm seeing definitive signs the bear market is over tomorrow. You got to get fully invested. No, I probably won't say that anyway, but we'll just follow the market, the evidence, and our market timing indicators, which are still mostly negative. That said, I do think you should have your watch list ready and keep an open mind, because the market's looking 6 months ahead. And if it wants to get going, it will. And after this Fed decline, we haven't been able to bounce, which is not ideal. But if we do bounce from here, again, we've sort of put in this really 8 months of no progress down, and it's allowed these moving averages to catch up. We're seeing with the new lows, fewer stocks participating on the downside. Don't get me wrong, there's still hundreds of stocks that hit new lows when the market comes unglued, but fewer and fewer stocks kind of over time. So there is some evidence in place that the sellers are, running out of some of their ammo. And now let's just see if the buyers can actually step up here for the first time in a while. Okay, that's all the time I have for today. Be sure to come by again next week when I'll be doing the second Cabot Weekly Review of the year.